Sunday, November 15th. Welcome to a new episode of Bazaar. I'm your host Sid, and joining me today is Anmol and Siddhant, all the way from Bangkok. It's great to have you guys here.
Hi, it's great for us to be on the show as well.
Yeah, it's great for us to be here as well.
All right, so this week we are going to be talking about Jet Airways, and a couple of weeks back there was news of a renewed interest to revive Jet. A consortium led by Kalrock Capital and Murari Jalan placed a bid to acquire Jet. And before we dive into the deal, we'll take a quick look at the rise of Jet Airways and its iconic fall. We'll also cover Jet's stock performance. And for those who don't know, who've not been following the stock, Jet's stock has been the world's best performing airline stock in 2020. Yeah, I mean, this is a bankrupt company that we're talking about. So, to begin with, Anmol, when did the story of Jet Airways begin?
Right, so we go back all the way to 1953 when the Air Corporations Act was established. So essentially, what that did was it nationalized all air transport in India, and it provided that all the air corporations that are established, it would be only done through the acquisition of existing airline companies, and that would the thought behind it was that it would improve operations of air transport services. So the two corporations set up through that act were Indian Airlines and Air India International, who then merged to become Air India as we know it now. And the move was aimed at providing safe, efficient, adequate, economical, and smoothly coordinated air transport services domestically and internationally. So by far-reaching import, what the act essentially did was that it made the business of running private airlines completely illegal. So in my opinion, that move was a bad move because it undermined the benefits of giving any role to private institutions who might make the airline work better because they have the incentive for the airline to make a profit, and they can also create markets by protecting property rights. So they can create markets by cooperating with other private airlines in the international market, and they could also enforce contracts more regularly because again they have the incentive to do so because they will at the end of the day or they want to make a profit. um, so economic entrepreneurs would seek profits and therefore they would seek to create value. So in 1992 this act was repealed and the government announced an open skies policy, which led to the liberalization of rules and regulations to open up the commercial civil aviation market. This led to the birth of many carriers since then, including Modi Luft, Damania Airways, Air Sahara, East West Airlines, and Jet Airways. But sooner or later, these operators either folded their operations or merged with Jet Airways, withstood an efficient operator and gained market share with each passenger.
Hmm.
Yeah, and I think if you see Jet Airways' unique selling point throughout has always been the service that they provide to each customer. It hasn't been about the cheap ticket prices, which other airlines in today's day and age offer. It's always been about the experience from going to the airport, your stay at the airport, getting into the flight, and going home. So we can see that, back in the day, flying was considered a luxury rather than a necessary thing that people used to do. So people always wanted to get the most out of their time that they spent in a flight or at the airport. So Jet had services such as gourmet meals in the air, which were really appealing. In today's flights, most of the times, you have to pay for any meals that you want to acquire. So Jet had meals included in their ticket prices, which also made the ticket prices more expensive. But people didn't seem to mind that initially. Jet also provided customers access to good levels of comparable levels of service all across the world. Even in destinations where Jet did not have a hub, they would allow their customers or their passengers to access lounges for them to, relax, be comfortable before getting on a flight. So this kind of basically this is what helped Jet to get 44% of the market share between 2003 and 2004.
So in 2004, a new 520 policy was announced, which the 520 policy was that to because even though with the open skies policy in 1992, the government did not really open up the commercial aviation market for international carriers to for Indian carriers to operate internationally out of India. So what that policy did was, if you could prove to the government of India to the Ministry of Aviation that you are experienced and you have enough of a backup or a supply. So that would be if you have a minimum of 5 years experience and a minimum of 20 aircraft, you could operate international flights. So that's why it was called the 5/20 policy. And Jet was a key beneficiary of this change because from the time of their inception in the early 90s to 2004, they had really grown big in the domestic market. So this was the perfect time for them to go international.
Yeah, because Jet Airways ruled the skies for 13 straight years, and it also came out with its IPO back in February 2005, offering 20% to investors and raising around $350 million, making Naresh Goyal the founder of Jet Airways an instant billionaire. But I want to take a pivot here. In 2003, 2004, the cracks had started to appear, isn't it? Because ever since the entry of low cost carriers like Indigo, SpiceJet, Jet Airways had been constantly losing market share. So, what went wrong for Jet?
So I think problems basically began for Jet when they were trying to aggressively expand, especially internationally overseas. And they acquired so many different types of carriers. They bought 10 777s in 2005, between 2005 and 6, just after they had purchased 10 Airbus A330 flights to expand into long-haul international flights, long-distance flights, basically. And it's one thing buying these aircraft, but it's another also knowing how to efficiently run them with smooth timings, and also being able to maximize the profit and the revenue that you generate from each of these aircrafts. They also tried to buy Air Sahara for $20 billion, around 20 billion rupees, my mistake, around this time. But the deal was called off because there were many disagreements for the price. And once this deal did not work out, both airlines filed lawsuits against each other, seeking damages, which soured the relationship a lot. And, it made it really bad. So eventually, when Jet did decide to buy Air Sahara, they bought them for 14.5 billion rupees, which is around 209 million US dollars, which also was something that experts said was overpriced. So if the initial price of 20 billion rupees was overpriced, even when they purchased Air Sahara at 14.5 billion, people said it was massively overpriced. So basically a bad investment all in all. And this turned out to be a very bad investment for them, as all the flights that Air Sahara had were old, and the aging fleet, which basically Jet was forced to inherit when they acquired them. And also the corporate culture of the employees, the staff, and senior workers in Air Sahara, it clashed a lot with how Jet Airways operated, because each company had quite a big contrast in terms of their core values.
So in 2010, Jet was the largest airline in India on the basis of market share. But by then, they had already accumulated 9,000 crore rupees in long-term liabilities. Now, point to clarify that long-term liabilities are not a bad thing, especially not in the aviation industry, just because the prices of airplanes are so high that you're not expected to pony up $2.53 billion in cash whenever you buy an airplane. So long-term liabilities, if and when used correctly, can be a really good tool to help for airlines to expand. Case in point, Delta Airways, who have more than $40 billion in liabilities compared to $60 billion in assets, and yet are one of the most profitable airlines in the world, and also one of the largest by their fleet size. So these long-term liabilities, we can't say they were an indication of things going down, but they did signify how Jet Airways were really ambitious and they really wanted to expand. But I think one thing that affected Jet Airways negatively there was the financial crisis, which really impacted the international demand coming into India. Because as a reminder, they had only started operating internationally around 4 years ago, so they were still establishing themselves in the international market. And all of a sudden, in 2008, the financial crisis hit. People had less disposable income, so the international demand naturally went down. And right then, even though the low-cost carriers in India were not such a big thing then, but Air Asia was still coming up and about in the international market. And because Jet also operated flights within Asia to Thailand, to Vietnam, to Laos at that point, Air Asia was a big competitor for Jet then because they were able to offer vastly cheaper tickets. And then after that, 2010, 2011, Indigo started to dominate the Indian market with low cost fares, no frills services, because they realized that the market sentiment was changing. The Indian market did not care for all the lavish services that Jet could offer. They just wanted to get from point A to point B cheapest way possible, as long as they were safe. And of course, the airlines were safe because they were still being regulated by the DGCA. So this change in market sentiment was also partially influenced by the financial crisis. And what this meant was that Indigo became the largest airline in India in terms of market share in 2012, toppling the king Jet Airways only 2 years after Jet had done the same.
I agree with you because when you mention the no frills service, that reminds me because back in 2011-12 also I feel that the Indian consumer is of such way that don't give me food on a plane, I'll bring it. I'll bring a tiffin with me, I'll bring food with me.
Yeah, very good.
Don't charge me for food. So that's I think that's how the mindset had changed. People just wanted to get from point A to point B, like you mentioned. And also while we were discussing for the show, you told me that Jet almost ran out of cash in 2013.
Yeah, so in 2013, basically Jet were nearly out of cash, and the Abu Dhabi aircraft company, Etihad Airways, had to bail them out by purchasing a 24% stake in the airline. And their frequent flyer program, they purchased a 51% stake in. Basically, without this, Jet would have gone bust because they would have had no money anymore. So even they basically at that point had total current liabilities of around 11,800 crores, whereas their cash reserves were only 700 crores. So you can see the huge difference of them being unable to pay even current liabilities that were due. And in order for them to compete with the low-cost carriers that had started to take over the market, such as Indigo or SpiceJet, etc., or AirAsia internationally, Jet had to reduce their prices while they also kept their services at the same level. So basically, while their costs remained the same, their revenue that was coming in or the profit that they would have generated would either decrease, in this case, them not having any profit at all. With high fuel prices and taxes, this basically further compounded the issue for them.
Yeah, so even though Jet was considered to be a really efficient operator when they started, which can partly be attributed to the fact that back then they were only operating domestically, so there was just less of a mess. It was relatively simple compared to international flying, where you have a lot more regulations to deal with. You have visa issues for your employees, you have landing slot problems. So all of that adds up over the time as you operate internationally. So one of the things that I want to point out is that pilots can only be certified on one type of aircraft, and because Jet Airways had such a vast variety of flights, mainly because they did purchase some of the aircraft themselves, and partly because when they bought Air Sahara, they also inherited their aging fleet. So because pilots can only be certified on one type of aircraft, and Jet had a large variety of aircraft, this meant that Jet had to he had to hire a lot of pilots to keep all these aircrafts operational. So these different airplanes also required more specialized maintenance crews depending on their age, further increasing the costs. And another airline that's not doing well, who has a similar lack of fleet fluidity, is Air India, who also has a large variety of aircraft that they have accumulated over the years, which they're still running, even though some of their aircraft are more than 20 to 25 years old. And now old aircraft are not a unsafe aircraft, and all aircraft is not necessarily an unsafe aircraft as long as you can perform the right maintenance on it, but it is an expensive one to maintain. By contrast, the well-performing airlines of this era have one factor in common, which is their fleet fluidity. Indigo, which is now the king of the Indian domestic market, only flies the Airbus A320 family and the ATR 72 prop plane, whereas SpiceJet only flies the Boeing 737 family and the Dash 8 family. So this means that they can hire a smaller subset of pilots, because if one pilot says, "Oh, I can't fly today," they can just get another one to sub in for them. Whereas in Jet Airways, it was a more longer and arduous process, because they might have more pilots available, but that pilot wasn't certified to fly the aircraft. That might be the case. And another factor regarding Jet's fleet that increased their cost was just the average age of their fleet, because Indigo and SpiceJet are much newer airlines than Jet is. So that's meant that they had younger aircraft, and that in general requires less frequent maintenance?
Um, I mean, by February 2019, Jet Airways only held 10% of the market share, which goes to show how over the years from being the market leader, they only had 10% of the market share. Both Indigo and SpiceJet operated and had more than 50% of the market, but Indigo had 43%, which means, in fact, SpiceJet also only had 7%. So the wafer thin margins, the heavy competition, all the taxes being imposed by the government on aircraft fuel, airport charges, etc. Basically, this resulted in airlines turning commercially unsustainable, and with Jet losing their market share over time and not having as many passengers because passengers would switch to low cost carriers, it compounded their problems over time.
Yep, and we all know what happened in April 2019. Jet grounded their airlines. It was not in business anymore, and the fall of one of India's most successful international brands tell you that making money in the aviation sector is not easy. There's a reason why investing veterans like Warren Buffett have, through the years told that, just stay away from this sector because it's not easy to make money in this sector, and you need to just make that upfront investment, and the returns are slow. So the return on equity, the operating margins, all of that, it does not work out. And I know that if you have to make a long term investment, and if you're not able to generate that return over period, then you don't have a viable business. So these are some factors why Jet had to ground their planes in April 2019. I think the biggest of all was because due to Indigo and SpiceJet entering the market, they lowered their prices, but they did not lower their costs. And I think that's one of the most important reasons why Jet failed, because you got to make money. If you don't make profits, then it doesn't make sense. And I think Jet was making a loss 8 years. In the past 10 years, it reported loss for the past 8 years. So it just, the cards unfolded and the domino just fell at once. And it's interesting, you also mentioned Air India. uh, I'm going a bit off topic here, but the only reason Air India is still operational is because the Indian government keeps pumping the airline with money. Okay, and this money is not free. People like you and me are paying for it. It's the taxpayers' money which is being used here, and this money could have been used better somewhere else. But government of India, they are feeling that we got to keep this dead airline operational, so they keep pumping money in this airline, and that's the only reason why Air India is still alive. And this is another reason why the government should not be in the business of doing business, according to me. So that's me rambling over here, but anyways, it's been 18 months, and Jet might soon be back on the runways thanks to Kalrock Capital and Murari Jalan. These guys want to revive Jet at a time when global travel has taken a big hit. I'm not a fan of this move. I think this move could backfire very badly for these investors. But anyways, what do you guys think? Like, do you think a revival is possible?
Like if you see the current fleet of Jet's aircraft, SpiceJet has actually already taken over some of them, the B737 family. But I don't think that's enough. As what's basically needed is a new management that has a new vision for the airline and a big infusion of cash in order to keep the airline sustaining. And before any talks could even materialize, all interested parties specifically put forward that they want the current person in charge, Naresh Goyal, to step down from his board position. Even Etihad Airways, as previously mentioned, who bought a 24% stake, are reluctant to increase their stake due to their own precarious financial positions, largely owing to bad investments they made in certain airlines like Jet Airways, Aer Lingus, Virgin Australia, etc.
And right now, another thing that, in my opinion, the Indian aviation sector in particular needs is just they need a lot of. I think they need some new rules, some new regulations, because right now the DGCA and the Ministry of Civil Aviation, they have a lot of discretion, which means that airlines, in order to get things done, they have to cultivate a lobby of bureaucrats and politicians to help lobby for them. Jet did the same thing when they were active, and depending on the circumstances, a points return may have to do it again, which might not be easy because right now the market is more consolidated. If Indigo wants something to go its way, chances are it has a panel of people who are willing to go the extra step for them to do it.
I mean, the current resolution plan, which has been submitted by the group of investors who want to revive Jet Airways, I think it's just going to prolong the airline's misery. As first of all, they've promised to invest 1,000 crores, which will not be invested at a single time. It will be invested in delivered in tranches, basically. Some part at some time and some part at a later time. So this kind of reduces the whole impact and the point of the cash infusion itself. 1,000 crore may seem like a large quantity, but when you look at it in context of an airline business, in reality, it's not sufficient to revive a struggling airline business and basically start it from scratch again. As a reminder, you can see they already have more than 9,000 crores in long-term liabilities. So you can see in context, 1,000 crores looks like a very tiny amount and may not help as much at all. So the investment consortium has no prior experience as well in reviving any airline, let alone running one. So it'll be interesting to see how they, go forward with this plan.
Yeah, I mean, if you look at the deal in its essence, the banks are also taking a 90% haircut. I think they have the financial lenders, they have around 8,000 crore of, they have lent 8,000 crore. That liability is there, and they are willing to take a 90% haircut in that, and probably they also will get a 10% stake in the airline, in the revived airline, and Murari Lal, Jalan and Kalrock will get a 90% stake. But like you said, I might sound like an outright bear, but I feel that these guys are just throwing money at this, because for the next 3 years minimum, travel is going to suffer. Okay, because people are not going to travel as much as they used to before the COVID pandemic began. Okay, airlines would have to operate at 50 to 60% capacity. That's not a capacity level where you make money. Okay, and we have no idea what direction the crude oil prices will move. So if, for example, in the next 2 or 3 years, crude oil prices increase, then, at a 60% capacity, the airlines, it's going to be difficult for them to make money. So, that's one thing. Plus, like you mentioned, the new investors have no idea how to run the airline business. So they have to probably, retain the management, the top management, or, hire new people who can, completely turn around the Jet Airways story. But again, even after that, you have to negotiate with suppliers. You have to buy slots. You have to incur a lot of money. And honestly, 1,000 crore is not going to cut it. And I would not be surprised if Jet gets grounded again in a few years. Yeah, and even I'm optimistic when I say years. It could be months.
I mean, going forward, Jet needs to change its entire vision and USP because the current environment in the aviation sector simply doesn't allow for a luxury airline, so to say, to operate, because customers and consumers were already leaning towards low-cost carriers before COVID, and now this will exacerbate the issue even more as the levels of disposable income go down, and by extension, the recreational travel also goes down. And trust in the brand of Jet itself has also severely decreased due to their insolvency, as they're now considered to be less reliable by customers. I want to give an example that when in March, when travel took a big hit, where flight numbers, the seat operational capacity of flights greatly dropped, U.S. airlines, Delta in particular, they were able to get around $5 to $6 billion in cash infusion simply by selling their miles from the frequent flyer program to credit card operators like American Express, on the basis that they can then offer the points to consumers as incentive to sign up for the cards. And even though the airline made a big loss in the first quarter, American Express still knew that the airline is reliable, its frequent flyer program is reliable, and thus even they can stock up on their miles and it wouldn't hurt them. But would an Indian financial lender or an Indian credit card provider be willing to do the same thing with Jet, because their frequent flyer program was a good program before they went into insolvency, the Jet Privilege program? But I think that is representative of how the trust in the brand itself went down severely after the insolvency. So I mean, in essence, Jet Airways failed because they remained a dinosaur in the growing market.
Yeah, I mean, it'll be interesting to see what the future holds for Jet. But what really shocked me was that the stock of Jet Airways, it has been the world's best performing airline in 2020. And this is a company which is bankrupt. Okay, but the markets, they don't seem to care. And Jet stock has delivered more than 140% return for those who were bold enough to hold on to the stock. So what do you make of this insane stock performance?
I mean, as you clearly just mentioned, the dramatic rise of the stock price. However, this goes to show you that, earnings growth has no correlation absolutely with the share price appreciation of the stock. In fact, in most recent fiscal years, Jet Airways has failed to even break even. And in the last 2 years, Jet Airways stock price has fallen by more than 95%. So this goes to show you the staggering decline in its fortune, along with the loss of confidence of its shareholders. But at the same time, it's very difficult to make a conclusion on where the stock price will go, because even though it's been struggling and there's no reason to say that the company will, revive and be successful again, the stock price is still done really well if you take this year into context.
Yeah, I mean, not only the stock, the markets as well. I mean, it's hitting all-time highs. And if you look at the fundamentals of the economy, the GDP is contracting. People are still losing their jobs. People don't have that level of disposable income to spend. That okay, I understand that the demand is getting back on track, but it's irrational. And seeing the performance of Jet Airways, I can just clearly say that markets, you cannot predict what trend the markets are going to follow. So don't try following the trend. Don't try to time the market. And I was just thinking about it. I think here's where people have missed the trick, isn't it? When they're buying airline stocks, don't buy airlines which are operational. Buy airlines which are bankrupt. That's where the money is, isn't it? So anyways, we will keep tabs on this deal. We'll cover any updates that come in the next few months, and probably I'd like to invite you guys back to cover the updates on this deal, and we'll see how this works out. Forgive me if I sounded a bit harsh, but that's just my perspective. I could be absolutely wrong here. This deal could work out. Probably 1,000 crore, like we mentioned. I don't know. Some kind of magic could happen. The vaccine could work out. People could just start traveling in bunches, and who knows? We cannot predict the future. So let's see what happens. And thanks, Siddhant and Anmol, for hopping on the show. I had a lot of fun doing this with you.
Thank you for having us as well.
Yeah,
we
thank you
enjoyed
for
this.
having us on the show. It was really fun talking to you.
All right, guys, that does it for today's edition of Bazaar. People on the show may have certain recommendations to buy or sell, but don't buy or sell based on what you hear. Do your own research before you take any investing decision. You can reach out to us at thebazaarpodcast@gmail.com. We would love to know what you think of the show, and how we can improve the quality of the content, and what we can do to make this a better listening experience. So just have a great weekend, and we'll see you next week.